And now, Dr. Omarova, welcome and thank you for joining us today.
Well, thank you very much, Jo Marie, for inviting me today. I must say this is a disclaimer. This is not the usual audience for me and my presentations. I'm used to speaking to fellow banking law scholars about people who actually study financial institutions, law and regulation. And, you know, we speak a somewhat different language. We very rarely utter the words global poverty or neoliberal doctrine. I've missed that a little bit from my political science days, so thank you for that. Global commodity markets and global financial markets both are key to global economic development. I think that's hardly an eye-opening pronouncement. Dr. Espinel here highlighted the connection between the two by speaking of the effect of speculation on global commodity prices, particularly in agricultural commodities and foods, and specifically through the commodity index funds that are offered by U.S. financial institutions or global financial institutions to investors. Financialization of global commodities markets is a very complex phenomenon, Lots of factors shaping it, lots of actors involved, lots of different opinions as to whether it even exists, and if it does exist, is it a good thing, is it a bad thing, right? None of it is surprising because there's a lot of money at stake. And of course, when there is a lot of money at stake, there will be different opinions as to normative implications of such developments. So Dr. Espinel mentioned the fact that in 2000 there was a major deregulatory movement in the United States that allowed for a lot of this financialization to take place. And by that, I take it he referred to the famous Commodity Futures Modernization Act of 2000, which effectively deregulated over-the-counter derivatives trades, right? Basically saying over-the-counter derivatives are off limits for any existing U.S. regulatory schemes and agencies. And that's kind of going closer to my area, which is domestic financial law and regulation, and why it is important to global concerns with commodities and ultimately with poverty. I actually think that the more important but far less understood step toward these kinds of trends that we are witnessing today in this area took place a year early in 1999 with the Gramm-Leach-Bliley Act. When we speak of Gramm-Leach-Bliley Act of 1999, people tend to think about, oh, that was the time when Congress, quote-unquote, repealed the Glass-Steagall Act. Only partially correct statement. It is true that in 1999, Congress partially repealed the Glass-Steagall Act, which separated investment banks, securities firms from commercial banks. But as part of doing that, Gramm-Leach-Bliley Act accomplished another goal, and that's the focus of my recent research. In order to allow, as a practical matter, to securities firms to merge with commercial banks, Congress had to loosen up the existing historical constraints on the commercial activities of U.S. commercial banking organizations. In the United States, we have this long-standing, venerable principle, separation of banking from commerce. In other words, any organization that owns or controls a U.S. bank is prohibited, generally speaking, from engaging in non-banking, non-financial activities. There are various policy reasons for that separation. For example, we worry about the risk to the safety and soundness of a banking institution from engaging in all kinds of commercial activities deemed to be risky and more volatile. We're also worried about the conflict of interest, for example, that may exist when a banking institution has an affiliate that is competing with a commercial enterprise in some commercial activity, and so that bank may actually, offer loans to its affiliates on some kind of a preferential basis, or refuse the competing firm from getting access to credit, so on and so forth. There was also a very strong traditional concern, the sort of Brandeisian type concern, with the excessive concentration of economic, financial, and ultimately political power in these large financial industrial conglomerates that drove the law that was put in place in 1956, the Bank Holding Company Act, that was one of the key statutes that basically expresses that principle of separation of banking and commerce. So in 1999, Gramm-Leach-Bliley Act had to loosen that wall between commerce and finance. Otherwise, no securities firm would ever agree to merge with a commercial bank. And I've just written an article that speaks, explores that issue specifically. And if you're interested in that article, it's on SSRN. It's called The Merchants of Wall Street. It's actually a very long and boring article, but it does bring to light some stuff that we in the banking law world know about, but usually we're so familiar with it that we don't care anymore. And people outside our little community typically never hear of. And in that article, I'm trying to bring out some of the important implications of what happened then. So long story short, the reason behind the Gramm-Leach-Bliley push for allowing financial holding companies, that's the new category that law introduced for large financial conglomerates like Bank of America, like JP Morgan, Chase, and so on and so forth, to move into commercial enterprise was, at the time, banks really wanted to get into Silicon Valley. That's what they wanted to do. They wanted to invest into internet enterprises. Of course, shortly after the law was passed, the dot-com boom was over, the asset bubble burst. And for a couple of years, that law that allowed certain avenues for the banking organizations to start entering the commercial businesses were kind of sitting there dormant. It was nice for the banks to have this kinds of broadly phrased authorities, but wasn't used until about 2003, when, as again in Dr. Espinel's slides, there was a mention of that date. That's when the global commodities price boom really started in full, and that was, by all accounts, the most unprecedented price boom in the commodities sector in the world, and it's still sort of going on. And coincidentally, exactly around that same time, the large U.S. financial holding companies, starting with Citigroup and others, started coming to the Federal Reserve and asking them to grant them powers to start trading in physical commodities. And that was the first time when they actually utilized the power granted to them by Congress in that 1999 statute that was originally, they thought, intended to allow them to get into the internet business. So the Federal Reserve started granting them on case-by-case basis these certain powers to start buying and selling physical oil, gas, base metals, electricity, and so on and so forth. And the justification for that was the fact that these types of activities were complementary, sort of very flowing out of, and in some way necessary to facilitate very legitimate derivatives activities that these financial institutions conducted in the commodities business. So Citigroup argued we need to be able to trade physical oil because we need to be able to know how to price the oil-based derivatives. And that was considered okay, and the Federal Reserve actually imposed certain conditions on the ability of the financial holding companies to do that kind of oil merchanting or metals merchanting. And one of the main conditions was, okay, you can trade, but you cannot own or operate hard assets involved. In other words, you cannot actually own a refinery because that would be commercial enterprise, and we worry about potential environmental liability and all kinds of other liabilities that come with it. And so that continued. Under that authority, a whole bunch of large U.S. and foreign banking organizations actually started growing immense physical commodities trading empires, finding contractual ways to get around this limitation on the ownership and operation of these assets. But the game changed dramatically with the global financial crisis in 2007 and 2008. And the reason for that was the overnight conversion of two major Wall Street firms that were active since 2003, especially in the global commodities markets, Goldman Sachs and Morgan Stanley, into bank holding companies. So when I was in practice at Davis Polk, we basically, we spent a lot of time advising securities firms how not to become subject to the Bank Holding Company Act and not to become bank holding companies, precisely because that entailed all of these activity restrictions. And during the crisis, I could not believe. Personally, my world collapsed when I read in the news that Goldman Sachs and Morgan Stanley voluntarily asked the Federal Reserve to grant them that status. Of course, in that moment, the Federal Reserve did not go through the usual process of vetting all kinds of activities that Goldman Sachs and Morgan Stanley conducted at the time for compliance with the Bank Holding Company Act's prohibitions, for example, on commercial activities. So under the statute, Goldman Sachs and Morgan Stanley have up to 5 years of grace period within which they either have to conform those activities to the Bank Holding Company Act prohibitions or to divest them. And curiously, that statutory period, of course, ends next fall. So by next fall, the Federal Reserve has to make a decision as to what to do with these two firms' sprawling physical commodities assets. And what are we talking about here? And that's actually been the most difficult question in my research, because what I found out was that despite the fact that, Goldman Sachs and Morgan Stanley, of course, but also JP Morgan and also Bank of America and Wells Fargo and all these other institutions have been actually engaged in operation of significant, physical commodities assets. Despite that fact, there is really no public and regulatory disclosure of what exactly they do, how big their businesses are. They report certain financial metrics to the regulators, but on a very limited basis. Essentially, the only one that I found that was directly related to the physical commodities businesses was this, basically the fair market value of their trading inventory in commodities. That's all. But there is really nothing about the ownership of metals warehouses that, for example, Goldman Sachs and JP Morgan have now. There is nothing about really the extent of the oil pipeline and oil terminal operations that, for example, Morgan Stanley has. In order to dig through that information, you have to do a lot of research, and even then, a lot of it is unclear. So, in other words, one of the greatest discoveries I've made is that we don't really know what they own, what they do. We don't even know under what authority they own and do it now, and under what authority they will continue, if they continue to own and do it in the future. JP Morgan is another interesting case that during the crisis, JP Morgan actually acquired significant physical commodity assets of Bear Stearns, a failed investment bank in the United States, but also significant commodity assets of Royal Bank of Scotland, which was forced by the European Commission to divest specifically of its commodities businesses as its non-core business because Royal Bank of Scotland was bailed out by its own government. So, who picked up those assets? Of course, JP Morgan, which is a too-big-to-fail institution that came out of the crisis even bigger than it was before. So now we have Goldman Sachs, Morgan Stanley, and JP Morgan. And by the way, JP Morgan and Goldman Sachs own, for example, 2 of the 3 biggest metals warehouses in the London Metal Exchanges system in the world. And basically, how much do we know about how much business they do there and what that business exactly entails? We don't know. But the more interesting link here is this. Going beyond the sort of safety and soundness concerns that, what would happen, for example, if Morgan Stanley's oil tankers or oil pipelines blow up, right? That's a big question in and of itself. But going even beyond that, there is this concern with the structural market power that major financial institutions like Goldman Sachs, Morgan Stanley, and JP Morgan acquire by combining their key presence in the commodity derivatives markets with their presence in the commodities physical markets, right? Because by moving physical prices of oil, for example, or metals that underlie derivatives, they may potentially seriously move prices of derivatives. And so what it does, even if they don't do it in real life, which, I cannot ascertain, and I have no information to that effect, and therefore I'm not implying that they actually engage in this type of manipulation. But the possibility is there. The possibility is there because the structural market power may be there. And if that's the case, then we greatly complicate the regulatory enterprise, not only with respect to figuring out what's happening in the financial markets and to these financial institutions, as I used to think about them as financial intermediaries in capital markets, but we also greatly complicate the picture in the global commodities markets, because we lose track, we don't understand the factors that drive pricing anymore. Is it really just supply and demand? Is it speculation as we kind of see it through the investors flocking into commodity index funds? Or is it something more insidious? Is it something more directly related to complex trading strategies of these big financial intermediaries? And so these are the issues that I think that need to be addressed publicly. And of course, I don't have any advice exactly on how to go about it. And the real reason for my paper was to bring it to attention of people in my community, in my epistemic community, but also I'm glad that people in your community are now aware of this connection. Because if we bring that connection to light and if we actually start looking at some of the more technical aspects of what large financial institutions do in this area, we may find greater enlightenment with respect to how these activities affect issues of global development, global poverty, and so forth.
Oh, wow. I think we have an agenda for the administration's second term. And I'm hoping that, Saule, that you'll help us articulate at least the problem. Maybe we can get your article and lift some language with it and have you look at our summary.